you were the genesis behind Rockford and coming together here. How did Rockford come into the purview of Jay Jeffers? And let's talk a little bit about Rockford.
Yeah, so this is the project that actually found us. It's a massive historic factory complex. This had been known as the Colman factory that existed in Rockford for many years, and it's been a vacant site for almost the last 40 years. It's actually very similar to where we are right now. It's sort of like the Pabst Brewery complex, but of Rockford, going back, say, 20 years ago. You know, Pabst Brewery complex in Milwaukee was this sort of dilapidated ghost town of vacant historic buildings. It's a huge land area. That's actually very similar to what we have with Rockford. So the game plan is, this is overall, this is a 10-year program to fully build out the entire Colman Yards district. So we're going to do multiple phases of market rate housing development, commercial development. There's a big focus on food and beverage, hospitality. We want this to be an entertainment district. It occupies almost 30 acres in Rockford, all along the Rock River, so it's a big site, it's a critical mass, and there are a lot of historic buildings there. The reason I say it found us is because we specialize, J. Jefferson Company, we specialize in historic attached credit finance redevelopment of typically historic buildings, and we've actually done some level of factory complex redevelopment in Racine, Wisconsin. Former Horlick malted milk factory complex, where we started that about 5 years ago, and we're now on phase 4 of redevelopment of that district. And I think the city of Rockford sort of heard about our efforts in Racine, and they actually reached out to us and said, we might have another opportunity for you.
Great compliment. Can we get to the next slide? I know that I probably can do that, but is it right here?
Correct.
Thank you. Obviously, introduction, but myself, Scott Lurie, and joined by Josh Jeffers. I should have started with this. I was remiss in doing so, but all investment risks are there. I caution you that this is not a solicitation for investment. Please be mindful that there's all risk with all investments, and we are providing you with proper disclosure under the Securities Act of 1933. Thank you. So as Josh mentioned, obviously a catalytic, multiple phase, multiple site we're building here, live, work, play, entertainment district that we have going on. There's going to be tremendous vibrancy here in Rockford, Illinois. Pretty exciting. So tell us, Colman Yards, what you said was obviously a facility that you're going to have. What do you envision the total site encompassing from the amount of units? Talking pretty high level for us if we can. How many units do we have? And then what we'd like to get into is drill down into the actual investment thesis that we're talking about today.
Sure. So overall game plan over the next 10 years, we're looking at building just over 1,000 units of housing here. All market rates. The city asked us to specialize, really focus on market rate development. And it'll be a mix of historic rehabs as well as a fair amount of new construction housing as well.
So when you say historic rehabs, you're going to be taking the old plants, converting those, and then you're also doing some ground up construction on the site.
That's exactly it. That's right.
Beautiful. Nice renderings here of obviously what seems to be some of the housing as well as the square where it looks like there'll be some entertainment and other facilities. Here's some additional renderings. All of the renderings that we have are available to you at fstreet.com. The entire investment package is available. So I'm running through some of this a little quickly, or more quickly than I normally would, but if you'd like me to stop at any time or if you'd like to see any of this information, this is all being recorded as well as it'll be shared with all of our viewers as well as anybody on the investment group.
One quick thing I would say on this,
please,
is so we talk about over 1,000 units. 10 years is a long time.
Yes.
This first phase of development is really specialized in this area. So we're going to take 3 historic buildings, which is this big one here called building number 5. It's physically attached through a sky bridge to buildings 4 and 9. And those are the 3 buildings that will initially be redeveloped, converted into 250 apartment units.
Sure.
That's a part of this offering.
Sure.
And then the other big part of this phase of development is we're building this parking structure. So this is a 336 car new deck that really the city of Rockford is mostly financing for us. And it'll be connected by way of a sky bridge to in 2 points to these 3 buildings. So tenants will have secured, covered, heated parking, which is a very nice amenity.
Yeah, especially in Rockford or in the Midwest when we get to most of our time in the winters.
That's right.
Good to see, and obviously when we look at Rockford and we look at demand, which we're going to talk about in a little bit, you also touched on the capital stack and where this money is coming from, which we're going to drill into to learn more about Rockford and the credits we're receiving for the project are significant and really compelling for the investment thesis that we have here.
Yeah.
So here's a master plan. I think, Josh, maybe if you could high level just walk through the master plan. You identified obviously the first 3 buildings with the parking structure, but I think understanding the overall 10-year plan is relatively important to the overall investment thesis that we're contemplating today.
Sure. So, like I was just saying, this first phase of development really,
You can highlight those, yeah.
yeah, it really consists of this, the Founders Building, which is this massive building number 5, and it's connected to buildings 4 and 9.
Let me just make that different color.
Sure.
Thank you.
Building 5, right here, connected to buildings 4 and 9 here. Here we go. Here's building 5, here's 4 and 9. And then this is that new construction parking deck that I mentioned.
And so that parking deck's obviously connecting into all to the 2 multifamily buildings that are going to be
That's
as
right.
part of the first phase.
That's right. There's a sky bridge right here and then another one right there. And then this, I mean, this really constitutes this offering. This is all we're focused on right now. Similar to what we did with the Orlick complex and Racine, because this is mixed use, it's a master plan development, it'll be multiple phases over many years. This first phase does include a fair amount of streetscaping and site work, really for the whole rest of this district. So the way we look at this is we've got a great program in place we've got a development agreement signed up with the city of Rockford to do all this work over the next 10 years. But the approach that we're taking is that if none of that work ever happens, we still want this first phase to be able to stand on its own. We still want it to feel like a welcoming, inviting neighborhood.
Absolutely.
So there is a big chunk of capital, big chunk of cost that's going into this first phase of development. That's really for the whole district, to really make it feel like that inviting sort of environment.
Sure, and when we get into the capital stack, we'll talk a little bit about the infrastructure that the credits and the grants are being provided for to create the district that is not for today, but also the district that's going to be into the next 10 years, and obviously what will be the full plan.
That's right.
So, as Josh alluded to, obviously this is a phased development. As a phased development goes, there's infrastructure that comes into place, and in the first phase, there's 215 market rate apartments that are going to be built as part of the phase. So, Josh, maybe run through a little bit about stage 1. Obviously, time frame has been moved to Q4 of 2023 to get started here, but obviously maybe walk through a little bit about the adaptive reuse, the parking structure, everything else, and then I think one of the most important pieces is really you're shovel ready at this point, and so we're ready to break ground. We're ready to get moving forward.
That's right. We are. So at this point, we've actually closed on the bulk of our financing, and we've got a fully executed, guaranteed maximum price construction contract with a firm called ENC Construction. We've got all of our historic approvals, city approvals are all in place, and we're planning on breaking ground on this within the next 30 days.
Sure, absolutely.
By the end of November, we should definitely be well underway. And kind of like we talked about, so the overall game plan is we're looking at historic rehab of 350,000 square feet of space, which again, because we're using federal and state historic tax credits, all of that design work has been approved by the State Historic Preservation Office in Illinois, and the National Park Service. It does encompass those 3 historic buildings, buildings 5, 4, and 9. Will result in 215 apartment units and about 23,000 square feet of space. Just a quick comment on that. We actually have some pretty good pre-leasing traction with a major regional bank. We also opened a bank branch there and some of our commercial space, which is great. New parking structure, so that again, that's a new construction. It's 5 stories, 336 spaces. That parking deck is really designed to serve the 215 apartment units. Parking is very important in a community like Rockford, so we want to make sure that we're fully parked. Like I said, we are fully shovel ready. All our permits are online, and we are ready to move.
Excellent. So obviously getting into a little bit of the details on the stage, phase 1, and actually into the various different buildings. There's 3 buildings and a parking structure. Could you walk through maybe, obviously blowing up what you described in the easier one, we've got how many units in the Founders Building?
Yeah, so 181 units in the Founders Building, which is this building A here. This is by far and away, it's the biggest building within the complex. And similar to something that we learned when we did the Horlick factory complex redevelopment, in order to help this phase be able to stand on its own, getting the biggest building, the critical mass redeveloped is a big part of that. So
Absolutely.
we're just starting with the hardest part first, basically.
Sure, obviously these apartments are gonna have amenities, it's gonna be amenity-rich community, like,
Totally. Yeah.
like market rate Class A apartments would be. Maybe touch on, obviously you're talking about
Yeah.
a deck, there's gonna be some clubhouse, other amenities, obviously.
That's right. It's got, all in-unit washer dryer. There's also a lot of what I would call historic amenities that only exist in a building like this. So Building 5, for example, while this was built to be a literal manufacturing, they were making textiles in this building originally, I couldn't think of a better building for a multifamily conversion. The column spacing is perfect. The width of the corridors lends itself very well to a conversion to apartments. And speaking of amenities, the slab to slab height is about 16 feet on every floor.
Beautiful.
And it's all glass windows. So every unit is just gonna be like a light box, and then original restored wood floors, some plaster details. There'll be some pretty highly differentiated space.
Excellent, excellent. Obviously, we talked a little bit about the commercial space, other than, you said you're in discussions with some banks, obviously, there's 23,000 square feet of commercial space in the first phase. What else do you see might be a potential user for that space?
Yeah, so we're also talking with a fitness user right now. That could be part of the amenity space. It could also be part of the rent-paying 23,000 feet of space. But our thought process there is, we'd love to get a gym on site, for the tenants, rather than building, sort of the typical fitness room inside each building. We just want to have one big, up to 12,000 foot fitness facility that could double as both an amenity for tenants, but also a rent-paying tenant.
Absolutely.
Yeah.
So when we talk investment thesis and investment grade multifamily, we generally come to an IRR conclusion, right? So the IRR conclusion, for those of you who are not as familiar with IRR takes into account a time-sensitive exit from a project, which is what allows us to calculate this IRR. In this scenario, we're looking at, maybe let's talk a little bit about it. So we've got a little over a 19% projected IRR, and we have a hold period equal that makes that IRR calculation come together, which is a 4-year investment thesis. So maybe let's talk a little bit about how we got to what the 4-year plan is going to look like with construction, lease up, and then obviously the exit, and then a little bit about this partnership that we talked about that really, in my opinion, has really helped make this a very compelling investment thesis. So maybe let's talk a little bit about the 4-year plan.
Yeah, so like I said before, we're in a pretty good position to break ground within the next 30 days from today. We're in the process right now of mobilizing the site, and then it's 20 months of construction. And we want to start bringing some of the buildings online. Buildings 4 and 9 are much smaller, kind of like we were just looking at. Just that big building 5 is 181 units by itself. The smaller buildings we think we can complete earlier than 20 months and start to lease those up. Kind of helps out our lease up, our absorption projections. And but the overall goal is to lease up the buildings to stabilization over a 16-month period that begins after the end of that 20-month period. So basically,
so 20 months. So the investors' capital is coming in through the construction cycle. They're coming in through the lease-up cycle, and then on the 48th month, which is 12 months after that period, we're looking at an exit of the asset.
that's it.
Okay.
So basically, it's if you add up the construction period plus the lease-up period, 20 months plus 16 months, it's 36 months. It's 3 years basically.
Yep.
To build it, get it fully leased up. The exit in this case is a little bit different than maybe a typical real estate investment offering like this, in the sense that the exit is just predicated on a HUD 223F or similar loan refinance. So in other words, it's not a sale, but a refi.
Yeah, so it is unique, and I think the complications of the deal structure is what makes compelling as well as confusing at the same time. So I think it's important we at least talk through this a little bit. So
Yeah.
when a refinance happens in this scenario, the investors are being bought out of the deal at a refinance period through what I'm going to use as just an agency refinance, which is a large federal government agency program, whether it's HUD, Freddie or Fannie or whoever's in the market at that point, the most compelling thesis to get max proceeds.
That's right.
And that max proceeds is what's yielding this 19.27 projected IRR. So all of the projections and all the forward scenarios related to what is still the lease up and obviously the NOI that's going to be produced from the property. At the end of that 4-year period, what will be left is the investors will be out of the transaction with a very healthy 19.27 projected IRR, and the obligations or the further ongoing development due to its multiple phases will remain with the GPs in this transaction.
That's right.
Great. So in all of these deals that we develop, we always deal with a public-private partnership. It's one of the most important pieces of these deals. And TIF, which was always created for the but-for argument that has been loosened across the platform over the last 9 years, I think is now really dialed back into what is either a pay-go TIF or a performance-based TIF. As you deliver, you get. But there's also other incentives that are being provided here, which are really important for the transaction.
That's right.
Let's walk through these incentives because these numbers, they're real numbers and they're really large, and I think it's important because it's compelling to the investment thesis as to what happens. So maybe, Josh, let's run through your incentives that you were so diligent to obtain from the community, from the city of Rockford, as well as the state and obviously the federal government. So
yeah, I would say actually probably one of the number one most compelling aspects of this investment is the fact that there is so much public sector financing.
absolutely.
It really buys down our basis in the properties to a level where we can be leasing out apartment units at market rents that already exist in Rockford. We don't have to create the market. We don't have to push the market upwards. We've basically been able to get ourselves to an economic basis where we can just rent units at the naturally occurring market rates.
And that's generally what these grants or these TIF, the TIDs are generally created for, right? To create housing or quality housing communities,
right.
and so that's great. And this one's no different. The difference is the numbers are actually quite significant due to the site the infrastructure that you're laying. So
exactly.
Tell us a little bit about what you got.
Yeah, so a lot of the incentives are coming from the local level, from the city of Rockford specifically. Sure. And they really fall into two major buckets. The first one is the tax incremental financing that you hit on, the TIF. We're basically getting a 100% rebate of our property taxes, our incremental property taxes, which in this case is basically all of our property taxes for all intents and purposes, for the next 23 years. 100% of that comes back to us. That's a revenue stream that goes out in the future that we can discount back today and monetize it through a TIF loan. So that helps us out quite a bit.
So just for people, just for some clarity on that, so what happens is I'm going to use hypothetical numbers, but if a property is assessed with a tax base of $100,000 for the next 23 years, the project pays tax of $100,000 and receives the $100,000 back. Whether they actually make you pay it back and forth, the answer is it gets back to you, so your tax obligations to the project are zero. Your real estate taxes are zero for the next 23 years, which is very compelling. It's a long period of time, and the number is 100%, and you see that range from 65% all the way up to 100, and this project, based on Rockford's desires to materialize this, gave 100%, which is great. Max as you can get.
Yeah.
Okay.
Then the second bucket is just straight grants, essentially, from the city of Rockford. So, we're going through a corrective time right now in the capital market cycle. I can say that for our firm, we've used grants in the past, usually $100,000 at a time, maybe $1 million grant. What makes this project unique is that there is, and we see this a lot during down cycles, that at the federal level, the federal government will allocate grant money to cities across the U.S. to help push forward mission-critical projects like housing, satisfying housing needs, blight elimination, which is what this also falls under. And we're able to be, as a developer, the recipient a lot of those benefits. So our total grant amount here is actually $29.3 million.
So that's money that's coming into the project
That's right.
that has zero expectations of being repaid to anybody.
Correct.
It has dollars that are being part of the capital stack, as you'll see when we get to the capital stack. It's dollars that are coming into the project and there's costs associated with that. But between the two, the $29.3 million, the obligation of the project to repay is zero.
That's right. That's exactly it.
Great.
And this actually is a nice sign to what we were talking about before with the unique nature of the exit here being through a refinance. And you mentioned, part of the reason for that is to sort of, for lack of a better term, shield investors from a lot of the complexity that comes with a structure like this. So that $29.3 million of grant money, the we call this a high-class problem, but grant income is subject to ordinary income tax. So we've got all kinds of tax structuring that's happening at the deal level here that will take decades for that to work all the way through. And part of the reason why we have this 4-year hold period, and the thesis is really predicated on exiting investors through a refi, is because that way none of these tax issues affect the investors. There's not a lot of taxable income or anything like that that will affect individual investors.
Yeah, and it's a short period where you're not going to have such accelerated depreciation, or you're going to have a massive buy down of depreciated dollars. So overall, investors are bringing in their money. The money is being used specifically for the acquisition, the stabilization through the development, and then there's a refinance that will occur, which is then going to be the buyout of the investor that a projected 19.27% IRR. But at that point, Jay Jeffers and co-developer will remain in the deal for the next umpty-9 years as we continue to work through the next phases and the other additional commercial retail that's involved.
That's right.
Okay. So we talked a little bit about equity multiplier. I think it's also important that over 4 years we're projecting a 1.88 times multiplier. So per $100,000, you should expect $188,000 in return dollars to you per your $100,000. So think about the thesis: 48 months, and you put a $100,000 investment in today. The project and the GPs are projecting a 1.88 multiplier to your investment, which is a very healthy multiplier over a 4-year period of time.
It is, yeah.
So we talked a little bit about this. This gets us, I think, a little bit where it gets a little complicated, but I think Josh does a really nice job walking through it. And if you don't mind taking time, I think this is important. I think it's very important that we walk through essentially the project is $106 million of total development, which is going to be scary or to investors. This is a massive project, and it is because there's infrastructure and other pieces part of it. So maybe let's walk through our sources and then obviously our uses of capital, if you don't mind. Briefly running through kind of how we get to 106 and how we're going to spend 106. And then I'd like to briefly talk on this deferred developer fee that really is a placeholder of part of the sources and uses, but it never really materializes into $7.5 million to developer.
Right.
And I just want to clarify what that really is for everyone. So walk us through this.
Yeah, so at a high level, and I'll start with something you said before, $106 million sounds like a lot.
Yeah.
And it is a lot, it's a lot of money. The way to think of this though is it is fundamentally 215 apartment units. It's just that our average cost per unit is around $400,000. That's a huge dollar amount.
And it's more than market.
It's
more than
obviously,
market. So most people
way
see investment grade where we're looking at investments between $200,000 to $300,000 per unit, and this is double. It's in its worst case.
That's right. And why is that? Well, it's because we're taking old warehouses that have been vacant for 40 years and essentially rebuilding them. It costs more than new construction. And then we're building a parking deck in here. There's a tremendous amount of infrastructure, site work for 30 acres of land. So that dollar amount, it's a big dollar, but it's really, again, it's fundamentally just 215 apartment units. And so just to break it down a little bit, so we've got 106 million total. Out of that, we've got 2 loans on the property that total about $21.8 million of debt. So just right out of the gates, just think about that. $106 million project, $21.8 million is debt. That's about a 22% leverage ratio, right? Cost.
And these are the loans that are getting serviced, meaning they're the ones that have obligations for repayment that are going to be part of the ongoing cash flow of the building.
Correct, that's right, that's exactly it. So then we add the subject of our discussion today, which is that we're raising $8 million of essentially private equity money. And so in total, we've got, I'm kind of rounding here, but it's roughly $30 million of debt that's being serviced, like you said, we call it hard debt.
Yep.
And the 8 million of equity. All the rest of it, the tax credit equity, the TIF, the funding, and this deferred developer fee that we'll come back to, these are all really just subsidy monies that help buy down the basis. So out of 106 million, about $30 million of it is what I would call economic basis. It's money that is going into the deal and got to come back out.
So one could argue that of the 215 units, you could really do the math over $30 million versus $106 million.
Exactly.
And I think that would summarize basically how much is it per unit. If you take all of the extra dollars that are coming into the project, they're all for above and beyond market expenses that one would not have should it not be on this site, Colman, that needs to have the adaptive reuse part of it that's happening.
You got it. It's a great way of saying it. And then if you divide that 30 million by our 215 apartment units, now you're talking about $153,000 a unit. Sounds like right.
Sounds quickly, right?
That's right.
That's
right. So it starts to make a lot more sense. One thing so you mentioned this deferred developer fee. So what that is the long and short of it is that basically the development fee in a historic tax credit project is eligible for historic tax credits, right? And in this case, we've got a federal historic tax credit, which amounts to 20% of all of our costs, and then we've got a state of Illinois tax credit, which is another 25% of our total costs. So in other words, if you add that up, that's 45% of eligible costs in the project to qualify for tax credits. In this case, if we take this $7.5 million deferred developer fee, that generates, and then multiply that times 45%, that just generates more
credits.
More credits.
So this is not really being paid out. This is
Correct.
really used as a placeholder to get more credits for the project to reduce the overall cost from $400,000 per unit to $153,000.
That's right.
Is that a fair summary?
It's a fair summary. One clarifying thing I would say is it is paid out. It does have to be paid out. It's just that the way that we've structured it, it gets paid out to our investor pool.
So the $7.5 million that would come to a developer, as you hear developer fee, is actually getting repositioned or paid back to the investor pool. So the dollars, well, we can't say the dollars are going back to the investor pool because then we won't get the credits. We won't be able to increase the eligibility of the credits.
Yeah.
The developers are bringing this back into the investors as a shared resource of capital.
Yeah, that's exactly it. So our developer fee, as the actual developers of the project, is not even in that. We have a separate 5% developer fee.
Standard and customary 5% developer fee that we're taking as part of the development.
The development, that's sort of the real developer fee that's actually paid to us as co-developers. This $7.5 million is really just a way for us to generate additional credits, and it does get paid out, but it gets paid to the investors.
Absolutely.
We participate in.
Absolutely. So here's another look at that capital stack, and if you look at the same capital stack that's there, it's still 106 million, breaks all the way down into the 7.5 million developer fee, and all the way through there are the two loans. I think one of the most important things to really focus on is what is the actual serviceable obligation, and the serviceable obligation is really the construction loan at 11.5, the PACE loan, which is going to be serviced on the tax roll every year. And then you have obviously the $8 million of preferred equity that's coming in from the investor stack. So those are the dollars that are actually material to the project in terms of obligations and waterfall servicing that's a requirement.
That's right. I would just hammer on again, total development costs, about $400,000 a unit, big scary number. But our actual base is more like the 30 million or about 150,000
a unit is way below market in today's market. I mean,
that's what makes us attractive.
We've seen these are pushing $300,000 in some markets, and those are real dollars. So that's what is the compelling thesis at the end of the day. $153,000 of cost into each unit is an unbelievable all-in cost for a Class A market rate apartment in the 5th largest city in Illinois that's growing, and we're going to talk a little bit more about that as well. But we're going to go back. Obviously, stage 1 is complete. We're looking for completion in March of 2025, as we discussed. 215 total apartments. We've got some 23,000 square feet of commercial on the first building, 14,000 of retail space, and obviously the central building. And one of the greatest things that's happening is the city of Rockford is really supporting this entire deal by putting up this parking structure.
Yeah.
Parking is for any developer would automatically take $153,000 to $200,000 a unit immediately if you're going below grade for parking, but a minimum of $40,000 a unit in today's market for parking, and that's already being covered as part of the grant and the subsidy from the community. So
That's
that's
it.
great.
Out of that 29 million of grant money, about 16 of it roughly is for parking.
Goes to the deck. Amazing. Obviously, here's some more renderings of the site. Josh, so I'd like to briefly touch on obviously some sample units. I think the
Sure.
living structure is really compelling, right? You get these big 16-foot windows in some of the floors. You get these really massive, what are warehouse or lofty types of units that have vast light and really healthy living. Healthy living to me traditionally means longer retention of tenancy, which is a really big benefit, obviously, the financial stability of the project.
Right.
So let's talk. So how many units are we building that are going to be studios? How many 3-bedrooms? Let's walk through a little bit about what's happening. Obviously, this is the smaller building, 34-unit building, but let's walk through that.
Yeah, so this is buildings 4 and 9. And what you see with a lot of new construction multifamily is that, developers, and we do this ourselves all the time. I mean, we're driving to basically get units, to be a little bit on the smaller side. We want to be very efficient. We're trying to maximize that rent on a per square foot basis. And that same philosophy carries over here. It's just that in an old building, an existing building, you're sort of constrained by the 4 walls of the building, constrained by column spacing. So we tend to have units that are maybe a little bit larger than average, but the same idea applies. So here we're looking at, out of a total of 34 units, that are basically 6 studios, 21 bedrooms, 5 2-beds, and then 3 3-bedroom units. So we want to have a mix.
Good healthy mix.
Good healthy mix, but again, it is still focused. I mean, 26 out of 34 of them are basically one bedroom units or smaller.
Sure. Great. Obviously, looking at the Founders Building, this is obviously the largest of the buildings. What it is today, what it we rendered out to be, which obviously is missing this parking structure to it today. Obviously, that's part of it. So this is obviously the 181 units. In this structure, there's 67 studios, 98 1-bedrooms, 11 2-bedrooms, and 5 3-bedrooms, rooftop deck, co-working space, in-washer units, 10 to 16-foot ceiling, high clears. Should turn out to be a really desirable place to live when all said and done.
Absolutely, and this is a historic developer's dream building, because like I said before, if this were new construction, we'd want to mostly focus on studios, mostly focus on 1-beds, have a mix of 2 and 3-bedroom units to offer to have some diversity within the unit mix. But again, usually with old buildings, you don't really have a lot of choice, because of the column spacing, that sort of thing. As I mentioned before, this Founders Building is this huge, the biggest building on site. It is so conducive. It lends itself so well to a multi-family conversion. So here, like you said, we've got the 67 studios, 98 1-beds. I mean, that's probably what we would focus on if this were a new construction building.
Sure, absolutely. Very neat.
Yeah.
Obviously, the historic campus of what it would be looking like today, current condition, obviously to the rendered up version, this city lawn or the green space that's on the rooftop, obviously is a compelling space where people are going to be entertaining families, dogs.
Yeah,
everything.
we want to be a real gathering place.
Absolutely.
Yeah.
So some people have asked this question, and we're going to talk a little bit about but Rockford, Illinois.
Rockford. Yeah.
Obviously sits on a river. Obviously, is the Rock River. Let's talk a little bit about Rockford. So maybe you can just walk us through.
Sure.
Learning more about Rockford, I didn't realize it was the 5th largest city in Illinois.
Yeah.
But obviously, it's great. Talking a little bit about the jobs they have there. Love to just run through Rockford.
Sure. So outside of Chicago, Rockford, Aurora, Peoria, I mean, they're all sort of tied for, kind of the largest cities in Illinois outside of the city of Chicago, obviously. Rockford is, it's like a lot of, Midwest cities where we've done a lot of work in the sense that, these were great manufacturing hubs a long time ago, post-war America. And then, a lot of jobs, a lot of manufacturing jobs went overseas. A lot of cities, Milwaukee was the same way, sort of fell on hard times, 70s and 80s, and then they've just been kind of coming back and reinventing themselves ever since sort of the 1990s or early 2000s.
And obviously the river, being from one of the main, obviously, ways goods used to be transported, obviously, has changed. But obviously, the Rock River being an important piece of it. So, Rockford, tell everyone a little bit about what is Rockford. What's the? I mean, some people probably will never get to Rockford, but they're ready to make an investment in obviously the Colman Yards. What is Rockford?
Yeah, so a lot of people, actually I've talked to a lot of people who have had some connection through it, in the sense that it's a huge hub for club sports. So there's a lot of people who have been to Rockford for a baseball game for their kids, whatever it is. But what people don't totally realize is it's actually bounced back in a pretty tremendous way over the last 20, 30 years. It's got a very diversified economy at this point. It's pretty heavy in healthcare, aerospace. It's got a lot of pretty big aerospace companies that are there. The Rockford International Airport. So here's something that we learned actually getting into this. It's the second largest airport for UPS, for cargo, in North America. And it's actually, I think it's the 13th largest airport for cargo shipping in the US as well. So there's a lot of economic activity that's happening here. And what we like is, again, we've done work in cities like Milwaukee and some of the suburban areas. Market rate multiple 10 to 15 years. So sometimes we're the pioneer in a city like this. In this case, we really aren't. The market has already been sort of established. There's a rental pool here that knows what to look for in the way of amenities and expectations. We don't necessarily have to create that market. The challenge with this project, has been we've been working on this for almost 2.5 years.
Sure.
And it's very costly, like we said, $400,000 a unit overall. So that challenge has been, how do we attract enough incentives at the federal, state, and local level to buy it on that basis to get it to a point where we can build units that match those.
That equate to 153,000
Exactly.
Reality. That's great. Obviously, Rockford has a downtown. There's a downtown district. It's obviously part of public transport, transportation access. So Rockford is as a smaller community, still thriving by nature. It's nice to hear, obviously, those jobs that you referenced from all of those different companies are potential tenants.
That's right.
They're paying market rate rent. They've got high earning income, and as a result, they're looking for high quality housing to live.
That's it. And, it's about 75 minutes to an hour and a half outside of Chicago. One other nice thing about Rockford is it just got approved for its own metro stop. So Chicagoland area has the metro rail that runs to a lot of suburbs. Rockford's metro stop is slated for a 2027 delivery, which is a nice thing.
That's great. So we always talk about all these data points and obviously wonder, how did the data points come together? How do you know that you need 60 studios versus 11 3-bedrooms, and sometimes it's architecture.
Right.
Some of it is market driven, and obviously a market study has been completed. Can you briefly talk a little bit about Tracy Cross, who obviously did the market study here? Tracy Cross is an industry leader in multifamily market studies, and what Tracy Cross does as a global entity is they put boots on the ground in these communities. They actually are there asking thriving questions about community demand. Would you live in a 1-bedroom? Do you need a 2? How about a studio? And they gather really important data, which was a report was commissioned for them to do so, which was spit back. So what did we find during this market study?
Yeah, so we found that this is a supply constrained market, and we see this a lot with communities that have been revitalizing, for the last 10, 20, 30 years, but they're not quite to the level of being a secondary or a primary market, where you can just build new construction and the rents will justify it. Here, the reason that there's so much pent up demand for housing is because, so sure, we've got a super high cost per unit, $400,000, but even new construction would be, $250,000 to $300,000 per unit, all in cost. And the market rents here that Tracy Cross sort of identified are, roughly $2.10 per square foot, which is, it's probably modest by Milwaukee standards, but it certainly doesn't justify the cost of new construction. So,
and I think that's important as part of your. So I think for some of our viewers, a market study is done, which creates a compelling discussion for the grant discussions and the tip discussions to say, rents can only be X, and if I were to build this, the rents would have to be Y, and so but for we need to have affordable and not affordable by nature of distinction, by affordable just for the community, what can be supported by the community as a market rate apartment. And so Tracy Cross came back and said $2.10 is market rent, and of that, at $153,000 of the market cost, we can effectuate a 19% IRR over a 4-year period, which is how this all kind of comes together. So when you put a bow on everything, it's really market study driven by demand, by rental income, which gets to the thesis, which is what we're sharing with you today.
That's right. One last thing.
Yes.
That's perfect. One last thing I'd add to that is the absorption rate. So
important portion of it, how long is it going to take
how long
you
is
to
it
get
going to take
these?
to rent this? And Tracy Cross found that basically this market could absorb over 400 units of new supply coming online every year for the next several years. So that makes us feel a lot better about delivering 215 units.
Yeah, so demand is there. I think it's also important to see that there's no other apartment complexes coming online with 65 more units in the pipeline right now.
That's right.
And the community knows what's coming, right?
This has become a very high profile project.
And we also meet with the community and say, hey, we're gonna build 200 apartments over here, and then 2.5 years later, it comes to fruition. So, all good stuff.
Yeah.
We have a brief financial summary we're gonna run through. Obviously, this is available for you to dig into if you have any other questions. Myself or Josh are always available to talk to you, meet with you, further discuss our findings. So in high level, I guess let's talk about a little bit about where we are, because we're raising $8 million. We're about 75% of the way through that raise. We've got a little bit more money to raise. I'm hoping today is a day to sign up for Colman Yards. But let's talk a little bit. So we've got an $8 million commitment. We're projecting a levered XIRR at 19.27% with an equity multiplier of 1.88. But what does that really mean?
Yeah.
And let's talk briefly through that.
Yeah. So at a super high level, and again, remember this is it's a construction project, right? So our goal is to close on the $8 million of equity financing and start construction within this next 30 days. So that means anyone who invests now is basically investing at the point where we're starting construction and moving forward.
We're at the farthest point of investment. The last point of investment is now.
Is
in
now.
the immediate future.
That's exactly right.
So somebody could have pledged themselves to say, I'm gonna make an investment in XYZ project, and that'll be starting in 18 months. This is shovel ready, going in the ground, vertical now. So we're here, which is important. Time sensitive, it's important.
That's right.
To understand your investment.
And it's also important to realize that there's we're out of the woods on pre-development risk. You know, it's been a title, construction contract is locked in at the guaranteed maximum price. So we're shovel ready to go. But then on the flip side, it's going to take us 20 months to build it. So for the first year or two, there's not a lot of cash. I mean, the first year there is no cash coming in. We're building the building. The property is not placed in service, which little technicality means that there won't even be K1s distributed for the first year. Right? It's basically in production. In the second year, you can see we do have a fairly modest distribution that's projected, which is basically because, like I said before, we do have the ability to start leasing some of the units near the end of year 2 as they come online. So by year 2, we are kicking off a little cash, but then it's really in year 3 that we're starting to target some pretty high, double-digit returns on the original $8 million equity investment, because at this point, now the property is really it's completed, it's getting leased up to a stabilized level, and then obviously year 4 is a really big number because that's our exit year, where we're again projecting an exit through a refinance, some long-term agency debt that will come in and basically take out the original $8 million plus a return on capital. And I've had some questions from investors who've already committed to this, which have been along the lines of, is the upside capped, right? Is there some ceiling on what they can expect to realize? The answer is no, right? We've made some assumptions around what cap rates will be in 4 years, and spoiler alert, we're projecting them to be a lot higher than they have been over the last 4 years. What will interest rates be? But we can certainly outperform. I mean, if the rents end up being higher than $2.10 per foot, you know, that 13 million of net proceeds coming after paying off all of our construction debt, it could be higher than that.
And so what she's talking about, I think what people also have to remember is, as the demand grows, as the communities develop, if you can get a 10% or an 8% increase or renewal, which is not being projected, if year one is 210 and year two is 225 in terms of the rental income, it extrapolates out significantly on a cap rate versus, and then an exit refinance is really what this all dovetails into, which is this number on steroids, which is put into a massive calculation, which is a cap rate refinance at a leverage point equal to 80% leverage or 75% leverage in the marketplace and where interest rates are. There's a lot of variables to it, but I think conservatively these numbers are very obtainable. But what you said is no, there's no risk to more profits. There's no limits to them. It's just this is what's projected, and this is how we got to the 19.27% IRR.
That's right. Now, by the same token, it could be less than that. That's right. There's risk versus reward here. We're looking at projections, but you know, the reason why we put so much stock into that Tracy Cross market study is because, you know, we basically, the way this deal has been underwritten is we're using that $2.10 per foot from their study. We're using their absorption expectations. So we feel that we've been sufficiently conservative in coming up with something, a projection that allows us to outperform. And we want to outperform.
Always.
Absolutely.
So talking a little bit about the cash flow, people like to ask, like, hey, when should I start seeing some money? We obviously are targeting year two of cash flow coming back. Can you maybe walk us through the cash flow to the investor pool of what you're projecting, and then obviously what that looks like?
Sure. Yeah, and I think I'll focus really on this table down here, which is, this is a hypothetical return projection for an investor who puts in, let's say, $250,000. We've actually had quite a few people commit at that level. So like I said before, year one, there really is no cash because we're building the building. Year two, there's a fairly modest amount that works out to, again, these are projections. We're estimating it to be 5 to 6%, 5.5% cash on cash yield.
So that's just a calculation of whatever this return is into that investment gets you your cash on cash return.
That's right. It's the 13,729 divided by 250,000 gets you 5.5%.
Correct. So when we talk cash on cash return, how much am I earning in my money?
That's right.
You'd be earning at this projection of 5.5% for money in year two.
In year two.
Okay.
Exactly. Then year three, quite a bit more, because now, you know, we're projecting the building being fully leased up. It's throwing off a lot of cash now. And so same thing, take that 47,412, divide it by our original $250,000 investment, and now you're looking for like a 19% return, right?
Sure.
And then in that final year, you know, this is where, you know, we see a big pop because we're exiting.
When you say exiting, this isn't exiting through cash flow. This is a component of two things, right? This is a component of, obviously, cash flow from the building.
That's
But
right.
it's also a component of a refinance, which is recapitalizing this project and removing the $8 million of preferred equity and replacing that with just debt. And in exchange for that, their shares are no longer present. No, you
Correct.
no longer own your shares. You are out of this deal
Out of this deal.
at that value.
That's right, and that works out to about, I mean, that last year is a pretty big amount, 149.5%, again, estimated. And so you did a great job early on of kind of explaining the IRR concept, right? So what this also factors into, if you take sort of a 0% return the first year, 5.5% the second year, 19% the third year, and then this huge pop at the end, on average, that works out to about a 16.82% return per year. It's like an annualized return for each of the 4 years that the investors.
Some years are really good, some years are zero because we're doing stuff, like building the project. Some years we're stabilizing, and then obviously some years we're exiting. And so you take all that together, it gets you to what is this lever?
This average, it's like an average.
Correct.
And then, like I said before, I mean, the investor multiple is about 1.74 times. So, you know, this is based on 250,000. If somebody put $100,000 into this investment, they would get $174,000 back.
Out of that return.
Yep, that's right.
Okay, so obviously, when you go back to look at the difference between how we're getting to the $8 million, Jeffers is obviously an investor in the deal.
Yep.
J. Jefferson is putting in 10% of the cash, $800,000. The rest of the remaining dollars are coming from the investors on the total aggregate raise of the $8 million that's being raised.
That's right. So on that point, full disclosure, I will probably personally end up being the largest single investor in this project yet, which is very important, to me, to our company.
Well, it's important to the investors, obviously know that the GPs, the developers have skin in the game, right? You're the one that's gonna usher this to the finish line on behalf of everybody, and all of our LP investors need that support from the GP investors, so, very important piece of information.
That's right.
Development obviously is creating community value, that's what we do. J. Jeffers obviously is focused a lot on historic developments. F Street as a partnership with J. Jeffers is a multifamily development firm. With considering the amount of time we have left, I'd like to ask a couple questions for you that some of the investors might ask. We did create an FAQ page that I think is important for us to talk through. What happens to investors if there are issues with stabilization? Someone asked the question. I think the plan says to be stabilized by January of 2026. What happens if lease-up takes a little longer, right?
Sure.
So what does that do? Obviously, that's going to impact the IRR, right? It's going to pump this project out a little farther, which is going to deter some of those values. But what happens in that scenario, right? The project doesn't go to zero. We don't disappear.
Right.
What happens in that scenario?
Sure. So this is, again, one of the benefits of us, structuring the exit based on a refinance. There's no, exploding deadline for us to sell the project. We don't have any kind of, compelling reason to have to get it. It's not like any of these funds are going to disappear or delayed or anything like that. The reality is that the 4-year hold period could be bumped out, maybe becomes a 5-year hold period. And the investor IRR, instead of being 16.82%, it might be a little bit less than that.
Because as the time sensitivity goes, your money's involved longer, and as a result of that, assuming no upside in or material benefit in cap rate, you might see a little lower IRR return.
That's right. Now, on the same token, we have been in lease-up scenarios in the past where once we actually deliver the building and we're in the market and we got our ground game with our management leasing company and we're leasing up units, we sometimes will intentionally stretch out the lease-up period a little bit in order to get a higher rental rate. So
it happens, supply and demand in that.
Supply and demand, exactly. So you have some mitigating variables. So in other words, I guess my point is that a longer lease-up period isn't necessarily a bad thing. There could be some reasons.
And if there's a reason, it's obviously to increase revenue or to drive that.
That's right.
And just to belabor this point for one more minute, in the event that there is an elongated stabilization period, your money doesn't disappear, your investment doesn't go to zero. It's just the extension of the return might be elongated, which could reduce your IRR, but your protections are the same, your process is the same. The exit refinance, which is scheduled for 48 months, might actually happen in 43 months should favorable terms happen. So it could go to your benefit, but at the end of the day, the answer to that question is obviously a reduction in IRR.
Yeah, that is the most likely outcome.
Tess, is there an equity, is the equity a preferred return?
It is a preferred return. So the preferred return here is 8%.
Okay.
And one really important thing about that is, so let's go back to what I mentioned before about year one. There's no cash distribution in year one because we're building the building. Well, that doesn't mean that nothing is happening. That 8% return, if there's no cash that can be paid each year, it still accrues and compounds at the 8% rate, right? So if let's take some simple math. If an investor invests $100,000 in, at the end of the first year, if they don't get a distribution at all, their capital account goes from 100,000 to now it's 108,000.
And the reality is that first year, everyone's going to 108,000 because there's nothing to pay them off with. So So there is a preferred return, it's an 8%. What are the splits?
Yeah,
Somebody asked, what are the splits, obviously, and I think the question is, what are the splits on that free cash flow?
that's right.
And so maybe you talk a little bit about that.
Yeah, so best way of describing it is when we start to get a lot of cash flow in, that cash goes first to paying all the preferred returns that have accrued but not been paid.
So first to the accrued preferred return that it remains a liability to the entity or the unpaid
Exactly.
preferred return.
Exactly. So there's no disproportionate split of cash flow until everyone has gotten their preferred returns paid out.
So year two comes, I get my $8,000, that's already, year one, you pay back the 8,000, then year two, I would have another 8,000 compounded, so I'm using fractured math, but
Yeah.
simple math gets me to 116. Once that 16,000 is paid back, which is the preferred return, then the
That
question
was
is, what are the
That
splits?
was a split. So after that, we go 80-20. 80-20 split, 80% to the investor LP pool, 20% to us as the co-development GP. That goes up to a 12% IRR. We were just talking about the IRR before. If there's cash beyond even the 12%, which we're projecting it will be, then we go to a 70-30 split, up to now 16% IRR. And then if there's cash beyond the 16% IRR, which again we have projected here, so we're showing a net 16.82%. Any free cash available after everyone has gotten a 16% IRR is split 62. And again,
And so those are traditionally called hurdles that we have used for benchmarks, but those are benchmarks as motivation to GPs to increase cash flow, right? So as the returns increase, if we were able to get out of the gates 220 for market rent instead of 210, the IRR hurdles are going to be obviously much higher, which is in everyone's benefit to get to a faster, higher NOI stabilization number. So,
that's right.
are there any leases for the retail space? Not sure that was already mentioned, but we're curious what might be going on. Foot traffic, which you briefly touched on. So you touched on two items. Maybe we can recap those for the audience that asked the question.
Yeah, so we've got some real traction with the bank, regional bank that wants to open a branch there, which will probably be about 2,000 to 2,500 square feet, which is, that's a pretty good dent out of the total amount of square footage we have available. And then we've got a pretty large, we're not totally sure yet, anywhere between 8,000 to 12,000 feet of a fitness provider that could double as a rent-paying tenant, and then also a huge amenity for our renter pool.
And you have been, just to be sure, the development hasn't, once these retail spaces become visual to potential mom and pop shops, eateries, dry cleaners, substations, whatever they might be, those are when they start leasing. It's hard for people in the retail environment to start visualizing, oh, this is gonna be a great, banks are great, seeing that can visually say, I can take the corner, and they understand it. But there will be 23,000 feet of retail, and the bank along with the fitness facility. My vision would be that you'll be marketing this on the open market with a first class real estate firm that obviously will be trying to get us
local brokers.
brokers.
I would expect we probably end up with, we say retail space, but as a practical matter, are we going to land an Anthropology or something here? Unlikely, right? What we'll probably end up with is coffee shops, local restaurants, probably some professional or personal services type, whether it's a spa, yoga studio, something along those lines. It's probably a lot more of your local, regional type credit. If we don't have wild expectations on commercial rents here either. We've got, here in Milwaukee, we have some retail space that rents out at $40 a foot triple net. Here in Rockford, we're looking more like $12 to $13.
Right, so very low expectations, high rewards. Should someone come in and build out? I'm assuming the bank tenants obviously pay X, or the corner, which might be a little bit more.
Probably a little bit more.
So that's
some of that inline space that you get a local, personal services firm. $12, $13, $14 a foot triple net. That's a pretty affordable rate for most of your local and regional services.
Absolutely, very standard.
Yeah.
We got one last question. Obviously, be mindful of everyone's time. Josh, we have a question where it says, are there any other projects in Rockford that might compete with this project, and then specifically housing projects, housing competition? I think we touched on that on one of the slides earlier that said there's no more than a 65 unit you building in a pipeline, maybe you could just extrapolate on how much this means to the city of Rockford. Rockford's obviously going to be supportive of this development since they're putting in $30 million of grant money, et cetera. Maybe talk a little bit about the partnership one more time, and then obviously where we think competition is from the housing elements.
Yeah, so I would say, the short answer to that question is there housing competition? Yes, there is. There are other market rate developments here. But the way I look at it is, I like that. Again, sometimes with a pioneer in a market like this, but 9 times out of 10, we prefer to actually not be the pioneer. It's nice that someone else, there are other developers that have already been successful here in the Rockford market. The major differentiating factor for us, there's nothing of this scale in the Rockford community. There's just nothing that is, a big historic factory complex like this, mix of uses, this major focus on it becoming an entertainment district and a real, community gathering hub for the city of Rockford. So from a critical mass perspective, just the public high-profile nature of it, there's nothing like it. We're very, we've got a competitive advantage from that perspective. And getting to your other comment about, just the unbelievable amount of community support that we have for this project. Again, we're a company, we specialize in doing transformative real estate development. This is, as complicated as this is, it's our bread and butter. We do, these complex capital stacks all the time. And as a result of that, we very often work with cities that are very happy to have us.
Like Rockford, very happy, supportive, they want to see this thing succeed, obviously, and we'll do all they can to make that happen.
Yeah. I mean, we haven't touched on this part yet, but I mean, just a little history on this. The city of Rockford has been slowly assembling the various parcels here over the last 20 years. This used to be a very contaminated site from an environmental perspective.
Sure.
And the city of Rockford has put millions and millions of dollars into cleaning the site, remediating it, getting it a clean bill of health. And they've really been waiting for a sole kind of master plan developer to come in, acquire the fully assembled site. It's a clean site. There's a lot to like about it, but they've been waiting for that right developer to come in, to share a vision with them, to create something that's very transformative for the area. So this has generated a lot of PR already. We've met with over 100 local businesses and community stakeholders there, and we haven't even gotten a shovel on the ground yet.
Well, they're on their way.
That's right.
Josh, thanks for your time today. Thank you to our audience who joined us. We appreciate the thoughtful questions. We're really excited about Colman Yards. This is going to be available to everybody by a web link, which you'll be able to share with anybody that might be interested in an investment. Josh, it's been great to be with you today. I appreciate my F Street team. My name is Scott Lurie with F Street. Obviously, thanks Josh Jeffers with J. Jeffers & Co. For being here today. And we hope if you have any questions that you want to bring direct to Josh or myself, we're available whenever you'd like to reach out to us. We look forward to your support and obviously investment in Colman Yards. Thank you for your time and have a wonderful day.